And welcome back, everyone, to another Pivot podcast. My name is Tracy. I'm one of the co-hosts, and I am here once again with my amazing co-host, Mr. Dan Jansen. How are you, sir?
What is up, Tracy? I'm doing awesome. Just getting over Super Bowl weekend and back at it into the market, the crazy, volatile market with headlines coming out and just every 2 seconds things change. But we are mid-earning season. So as we're just kind of getting through that, we wanted to create an episode of basically what to look for, why earnings are important, and just kind of start to understand a little bit about more of the fundamentals, even though right now, in a shorter term basis, a lot of the headlines are going to move the markets. But you also want to make sure that if you're investing long term, you don't have any short term plans to sell. How do you pick those companies that you actually want in your little investment basket? So I think it's super important episode.
Yeah, for sure. So let's start out by first kind of explaining to our audience what earnings is. What exactly does that mean?
Yep, so good question. So basically, very simplistic. So every company is going to report earnings quarterly. So each company is usually 4 times a year, and they release guidance with the earnings as well. So you have an understanding as to where their outlook going forward is in the company. You understand how they did that last quarter, what their expenses are, how much profit they made, and then you can actually really dig deep into earnings and see how that company's spending money and all of that good stuff too. So it gives you a full financial picture for that quarter for the earnings, and you can kind of basically relating those to past earnings and how they, as far as they predicted the quarter would go and the year would go, how on pace they are, or if any hiccups came in the way and things like that. So you could just kind of tell how well run a company might be.
Mm-hmm. Now, do you think that it really has a big impact on the short term of the company, or is that more of a long term kind of fundamental that plays into the strength or the future of a company, and really the earnings report is just an emotional reaction to it initially and can play out one time only?
Yeah, so I think both are true, honestly. So obviously, whenever the earnings come out, that company's going to react based on if those numbers were better than expected, worse than expected. So you're definitely looking for short-term moves, usually the day after, or if it comes out that morning, then that day you'll see definitely immediate reaction. In the longer term basis, that one report probably doesn't matter as much, but what you want to see is a trend. So you want to see that each quarter that the companies are able to either increase their revenue, make sure that they're growing, or two, start reducing some of their debt. Mm-hmm. And if you can see that the company is in a good financial position where, for the most part, quarter over quarter, that's happening, there's always going to be some kind of outside aspect that could be inflation, could be the economy in general, a policy that was passed, whatever the case. But you're able to see, like, okay, they were pretty much on pace with what they were expecting. And with something like that, that's if you're and it's very much so a Warren Buffett style trading. He's looking at something that's not that sexy, Coca-Cola and companies like it, and he's looking at, do they make money consistently, and are they growing? Are they able to sustain, or are they maxed out on their growth? And if you're looking at that, you're able to say, okay, this company quarter over quarter has solid earnings, solid growth. You know, you might not make a killing in trading, in investing in Coca-Cola, but you're not going to be losing money in Coca-Cola. For the most part, over a longer term period, they have a consistent product that people buy and use, and you can tell by looking at the quarterly, going from quarter to quarter. Typically, I'd say you want to look at the last 4 quarters just to get a good rough estimate as far as how that company's grown recently, and then you can probably take it back as much as 5 years and make sure that it's got a good trajectory for that stock.
It's interesting that you mentioned Coke, because it's the only company that's in my watch list that's currently above its prior year's high. That's it.
Yeah. Well, especially right now, a lot of the DraftKings are pulling back, Pelotons are all pulling back. So these are all companies that made a lot of people a lot of money, but none of that would be in Warren Buffett's portfolio.
Mm-hmm.
So he's looking for something like the Amazons. I think he's got Apple. I'm pretty sure he has Amazon as well, but definitely has Apple. He's got the Coca-Cola. He's got the solid companies that are performing strong growth. So on a shorter term basis, yeah, there might have been much more opportunity in Peloton,
Mm-hmm.
but he's not really so much worried about the day-to-day movement of the market. He's looking for the overall, how is this company going to be in 10 years?
Now, are you an earnings trader? Like, do you look for earnings gaps and look for earnings fundamentals?
So I'll definitely trade the gaps from earnings. I don't. Sometimes I'll play pre-earnings as well, but typically I'm playing after the news comes out,
Mm-hmm.
because that's a good way to identify who's being trapped in the trades and how fast people might want to either invest in that company or be able to just say, I'm selling, I'm going to take a loss, I'm freaking out, this dropped too much. So I find after the earnings, it's a lot easier to play. But there's some option strategies that you can take and kind of base it around, pretty much base it around the earnings that come out. So one of them would be usually with the premiums of the options, you tend to see some kind of a run-up in premium starting from about 2 weeks prior to those earnings. So I don't even wait until the earnings for that. I'll buy 2 weeks, I'll buy a call, whatever. And then the day before earnings is when I look to take out. So I don't really like to play the volatility of what happens after the earnings,
Mm-hmm.
because you never know what could happen on a certain quarter for a company.
Mm-hmm.
And no matter how good that position looks going into it, the next day could paint an entire different picture. So
Mm-hmm.
unless it's something that I know the company, I know I'm investing in for the next 10 years, I don't really worry about getting out of position or anything like that. But I won't open new trades very close to earnings unless it's designed to do that.
Yeah, and we'll talk a bit more in the next couple episodes about how to play earnings, how to play over earnings, some of the strategies that you might want to play pre and post. So we'll talk about that later. But for now, what are your favorite places to, I guess, look for earnings? Because I use two in particular. Usually my broker, first of all, has a little indicator that shows up that says, hey, you've got earnings showing up tomorrow for whatever company, but it has to be a company that's inside my watch list. And then it'll tell me that. Otherwise, if I'm curious, I use Earnings Whisper. So I'm not quite sure what you use.
Yeah, so earnings Whisper is solid. I'll use that one a lot as well. I'm going to find out what companies. You could even go to like CNBC will have upcoming earnings schedule and things like that too. So a lot of those media outlets, I'm sure Bloomberg will have the same, things like that. But for the most part, Earnings Whisper is what I'm looking for. I think they have good, solid details about what companies.
Mm-hmm.
Otherwise, I'll pretty much have a watch list as well, similar to you, and I just kind of know the stocks that I'm trading the most, and I start to learn pretty much when those earnings come out. So I'll have a rough idea, and then if I do want to take a trade that's going to be more than a day trade of just holding it in and out, I'll look deeper because I know that the earnings are coming up. But as far as looking at the actual earnings, I'm looking for, usually I use FinViz a lot for
Mm-hmm.
finding out more of the details behind the company. And then obviously for when earnings come out, Twitter's good. StockTwits is actually pretty good for that because people throw in the reports right away, and you can see what pretty quickly what the results were for stocks like that. So in real time as they're reporting, I'll tend to do something like that where I just get my hands on the information quicker.
Mm-hmm. Oh, fair enough. And if you're new to trading and you're using TradingView, because that's one of the brokers, or not the broker, but the platform, charting platform that I use. First of all, your earnings are going to be showing up right beside the ticker in the bottom right hand corner, where you have kind of all of the, I guess, the statistics, or the what's the word I'm looking for? Just all the price action. Yeah, the financials, right. The price action, everything that's happening. You'll see the name of the ticker or the name of the company, and then right beside you'll see a number in a red box. And that's the time that it's going to be till earnings. Now, I would like to put out a little caution. I have found that TradingView has a tendency of being inaccurate on when their earnings are. So that's why I personally like to just double check that either with my broker or with Earnings Whisperer just to confirm those dates, because I don't like to trade over earnings. So I like to be out of any positions before earnings happens. So I want to make sure that I get that date correctly and not prematurely close out a trade or not accidentally stay in because the date was incorrect. So
Right.
just wanted to get that out there.
I agree. I've seen it in TradingView where it's not. Sometimes it is correct. Also, when you deal with earnings, there's sometimes like they have a date listed for the company, and I mean you can even go to the company's website and check out what day they're going to put out earnings. But even that, sometimes either earnings could get leaked, or I've seen companies aggressively put it out prior to that date too. So it's always in that time frame. Usually, it's on the day that the company's putting out TradingView, and there's some other ones that try to post it, but some of those dates change, and a lot of times it could be a little difficult to keep up. But I think Earnings Whisper is usually relatively solid as far as putting out the correct days and times and things that will come out.
You bet. Now, you and Robert Falco basically put out earnings reports regularly. When do you guys typically post those? And can you tell us a little bit about them?
Yeah, so obviously during earnings season, which is a certain time frame where in that quarter where pretty much all the companies are, or at least a lot of the bigger ones are posting, we'll try to focus on the ones, because there's so many, you just can't. I mean, I guess we could do a video on every single one, but I can guarantee nobody's going to put that much time into watching them. So the ones that draw the most interest from people, the ones we try to put out, the ones that we know the community of real life trading has some kind of interest in, the bigger guys, Amazon, Apple, Google. We did one on NEO when NEO was popular, Teslas, things like that. So we want to focus on the ones that, number one, we know there's a lot of interest to. And two, there's some stocks that could actually move the entire market as well. So the Amazons, the Apples, things like that have the ability, not so much on the earnings themselves, although a little bit, but more of their forecast. So once they put out guidance, if a company like Apple, and this happened, what was it, last year sometime, they didn't put out guidance, which is not uncommon. Some, like a lot of companies will not put out guidance, but because of coronavirus, they were not sure like how the economy is going to respond. Even though that's Apple specific, Apple is such a big part of the actual industry itself, the SPY itself, the Dow itself, all of that. It's part of a main, and that alone, any non-confidence in Apple will also start to drift over into the regular market too. So it's not exactly exclusive with some of those guys, and those are the ones that we're kind of focusing on. But yeah, after we'll usually do it that night. We'll record it and try to get it out as soon as possible, so the information is relevant.
Okay. All right. Now I'm curious because you've brought out guidance a couple of times. Now that's kind of like the future forecast of what they expect the company to do over in the next little while. Now, I've been trading for a while now, and I know that, I don't know if you remember this a few years ago, but all of a sudden we were having conversations in real life trading, and it's like the earnings doesn't matter. It's what the guidance is. The guidance is what's going to dictate whether or not the gap is going to be good or good, bad, or whatever. It seemed like the market didn't really care about the earnings report. We were getting tons of great earning reports, but terrible guidance, or vice versa. Do you have any, because I don't have an answer to this, but do you ever know when, well, I guess what kind of dictates whether the guidance or whether the earnings report is going to be more important for us to pay attention to?
So what I look for is a great question. What I look for personally is I'm looking for a lot of the companies that report really good earnings and sell off on good earnings. A lot of times they've run up into the earnings. So the prices move dramatically. There's already a lot of people in, let's say, bullish, and then the report comes out and they have an amazing report, and it's just not, it doesn't ever feel like quite good enough. All that really is people taking profits. So those type of companies, what I'll do is I'll just kind of add them to a list to watch. And as they're pulling back, I'm like, well, the company's doing phenomenal. Like, and I'll do the same thing. I'll go back, compare it to the previous quarters, make sure they're growing. And then as that dip comes, they're on my watch list to pick up some of those shares, because they have solid numbers and just kind of ran too far too fast and has to pull back. People will go into want to lock profits. But a lot of times, as far as like earnings and guidance, when we're looking at the stock market, people don't invest on today's price, right? What they're actually looking for is how this company is going to perform in the future. The price of today doesn't really matter, except if it's overbought or oversold, and that's really up to if people are interested to buy something at that price. But if I was saying, okay, I want to take Tesla for the long term, I want to know what their guidance is. If they're predicting, like, hey, we have great delivery numbers coming out, or we have a new product line coming out, or we have a new factory we're being built. Those are all stuff that you want to be bullish on, and that might be certain aspects of that guidance is saying, great, they've been on time as far as deliveries, manufacturing is good, they're expanding their plants out, and that might be something that would appeal to a longer term investor. So something like that. But if they're missing, if they're said, hey, we'd like to put out 1 million cars this last quarter and we fell 200,000 short, to me as a longer term investor, that would be a little pause, a little side to just wait to get in, just because maybe there's some kind of, either one, they're just overestimating, or two, they just don't have the real capabilities to produce that kind of number. Or, as we saw in Peloton, it's very possible that demand is actually down as well, and people are just ordering that product. So I'll look for stuff like that based on it's almost the earnings are important, but the conference call and their guidance of what they put out, I would tend to put a little bit more weight behind as well.
Okay. Now, what about earnings per share? How does that play into the whole thing?
Earnings per share, that's just kind of you're going to have, again, it's weird, but it's not so much the earnings per share, it's what Wall Street predicted their earnings per share should be. And that's where you could go on to Earnings Whisperer. You could get a rough idea for what the actual market is expecting for that. And that's where you get those when people say, oh, this company beat or this company didn't beat. It's comparing it to what was expected. So the earnings to share, yeah, if you have a considerable higher valuation and they beat on revenue, the earnings per share, they don't have a lot of debt, things like that will play into if people will interpret those earnings as good or bad.
Gotcha. Okay.
And the other thing that we'll cover a lot, or for myself and Falco, especially when we're doing those videos, we're definitely looking at the debt of the companies. So I know I mentioned it a few times. If they're making $1 billion per quarter, but they're spending $2 billion per quarter, it's not really a healthy company. So they have to do something. Twitter is notorious for this. They make a lot of money. I think they have a good product. People use them. They have the celebrities on there promoting Twitter by the use of them being able to communicate. So I think it's a valuable tool, but somebody like Twitter, they just keep on spending money every single quarter on what, and then on the actual earnings that come out, you can actually see like they're spending it on advertising, networking, trying to grow users, all that, but it's consistently increasing with their net income too. So for me, I wouldn't look at something like Twitter until they started to show a decline in debt, that they're going to be something that I want to put my money behind for right now.
Or at least a massively larger income so that they're profitable versus, you got to take the bigger picture, right? You take the income minus the assets minus the liabilities, and if you're negative, then it's not very good. You got to be positive.
You're 100% correct. Yeah, so it's not so much. I mean, it's okay to have debt. It's most companies do. It's realistically, it's healthy. It's what kind of debt that is, and how sustainable is that debt? Like, is it a one-time debt? We just saw that in Robinhood 2 quarters ago. They spent $1.4 billion in the quarter, which very negative. Like, that was a much higher number than they've ever spent before. But a lot of that, after reading the reports, they were building out the platform to get into crypto so that people could trade. So I think that's, I don't still tell people now that ask like, hey, is Robinhood cheap enough? Should we get in? Again, that's up to you. It's your decision. I'm not a financial advisor, but for me personally, I want to wait another couple quarters just to see how that plays out, because it's not, they're not going to spend $1.4 billion and then just because they have the platform they're making it all back. I do think that in a longer term picture, which Wall Street has zero patience for, looking at the progress of how they spent and then how much revenue now they have from the crypto division, to me is going to be something that I'm watching for the next couple quarters. And once we start to see some kind of potential, like just increase in revenue because of the crypto platform, I think in that sense it would be wise to start to look to invest.
Right. And a lot of those companies where they're newer companies, they're building these platforms, they're reinvesting money, they're doing all sorts of things to grow really quickly, and that's obviously going to keep your debt high. That also, I think, is one of the reasons that it plays into such high volatility with a lot of them, which makes them great for day trading, if the liquidity is there anyway. But the volatility, you can get some massive moves in a very short period of time. But that's, I guess, for a long-term portfolio, you don't really want to see that, right?
For a long, yes, yes and no. So in a long-term portfolio, for the most part, especially for mine, it's about 70% of solid companies that grow, that have dividends, that have been around for a while. But I will put some speculative companies into that long term as well, because you will make more money, or you'll make a good. If you're sitting in Tesla when it first came out, it was very speculative. I mean, people, they almost didn't have enough to be sustainable as far as money wise. And I think they were trying to sell it to Apple and all that stuff. So at that point, yeah, it was very speculative that Tesla would even work. But if you believed in the product, you kind of see that there was a market for it. There's the demand for it. There was a lot of what they call fanboys, I guess, where anything Elon does, like, people get real excited. So by putting a little bit into that position, yeah, it's possible that the company doesn't work. It goes to zero. You have the rest of the portfolio to kind of weigh out any losses that you have by something like that. But if, like, Robinhood starts to turn and starts being able to produce better numbers, more consistent numbers over a course of maybe 3 or 4 more earnings report, then at that point, yeah, I think that would be a decent opportunity to buy. But I don't want to be the one to jump in just because it's got a name like Robinhood, where I know people use it, and some people like it, some people hate it. But when those numbers start to show, like, okay, what they've invested in seems to work, then I'd be more excited to be an investor and buy some shares for the longer term.
Gotcha.
Speculative company.
Gotcha. So if you're new to trading right now, what would you advise as far as earnings are concerned? Any tips?
If you're new to trading, I would stay away from earnings.
That's simple.
I wish I had better advice, but you're going to be, if you're day trading, you're in the markets grinding every single day. So you're going to take losses. You're going to take some wins. The idea is that you lose small, you're able to win more than you lose, and just by that ratio, you should be profitable in the markets. You could put a position into, like we were talking about Tesla, so let's say Tesla reports today. I could, before the market closes, I could say, okay, I'm going to risk an R on my trade, the same R that you'd be risking everywhere else, and they just get absolutely beat up and clobbered, and your gamble didn't pay off, and you've actually wiped out potentially 6 months of grinding in the market. So you're going to get into, anytime the earnings come out, no matter how good the company is or how bad, there could always be some kind of grenade hidden in there where maybe they did miss earnings, maybe the guidance wasn't good. And in a situation like that, I don't want to be the one gambling. I trade to make money. I don't trade to gamble. Otherwise, I'll just go to Vegas and have at it on the blackjack table. It's the same type of thing. That being said, there is some things you could do to. You could have some kind of option plays, a little bit more advanced option plays. Like I said, a lot of times leading into the earnings, people get very excited. That drives premium of options up. So I don't want to get into too much of that about it. But as, like, people will use like a straddle with options, and as long as that stock doesn't move like crazy, you're killing theta on both sides, and you're able to make some money. So there's ways to play it. There's options out there. If you're just doing shares, and you were either you got into the trade and unaware that earnings were coming up, and now you find out, I would just get out for a small win, small loss. Let the company do what and tomorrow you'll wake up, you'll see if the market's gapping or that stock is gapping up, down, and you could just kind of get back in and play it differently if you want to. But yeah, I don't like to keep the risk on the table if I don't have to.
Perfect. Now, this month, because last month we announced that we had a contest going, and it's actually due this month. So all of the contestants that are going to be participating in this need to submit their trading plan to us by the end of this month. Do you have anything in your trading plan that specifically talks about earnings?
Yeah, so I have a rule in there that says look out for earnings before taking a swing trade. Like
Okay.
if I don't know the day or the time, like make sure I get a good understanding of when earnings is. If I'm getting into a swing trade, which might be based on a daily chart, normally I might want to be in that trade for a week or two. But if earnings come out in 3 days, that trade could look drastically different than the original setup. So I'm more of a technical trader when I trade, and then when I invest, it's more fundamental.
Mm-hmm.
So I do use best of both worlds, but I want to make sure that my investing stays investing and my trading stays trading. So I'll make sure that if I get into a swing, that earnings are not within the 2-week time frame that I would normally probably be holding a certain stock.
Right.
So I make sure that I try to avoid those gaps as much as possible.
Right. And I'm usually about 6 days, I think. 6 days is typically where I don't want to take a trade before earnings. And I absolutely get out of earnings unless I'm able to put some type of a hedging strategy in place. That's the only time that I'm allowed to hold any of my positions through earnings. Now, that being said, I have taken some trades that haven't been options based. I've taken some trades that I guess would be considered risky because they are over earnings, but they were based on solid support locations, solid price action that was happening before. It just made sense that the risks were very mitigated, that the odds were still stacked in the favor that the move was kind of already done, if that makes sense. So that's about the only other time, but that's what I have in my trading plan as well, just to get out before earnings, and only allowed to stay over earnings if I have the risk on the table that I'm able to hedge with. So that's pretty much it. So make sure that when you're
the big key difference is that you're planning for the earnings.
Mm-hmm.
So
exactly.
Like, when you get into your trade, you know that the earnings are coming, and you have some kind of a plan for the earnings. So it doesn't just sneak up on you and hit you, which is important. And like I said, for newer traders, honestly, I would get more comfortable with how to read the charts, how to interpret the volume, how to do stuff when the market's already open, because that's tricky enough to make sure that it takes time to learn that. And then after you've been trading for a while, there like you mentioned, there's ways to trade with a plan for earnings. There's option trades that you could do, and then sometimes, like in a very rare case, let's say I got in extremely low and I'm extremely profitable in this trade, and then I want to either sell some shares, take some reduce some risk, and then have the other just kind of ride. Like there's things to do with that. But if you're very new to trading and very new to earnings, I would highly recommend just trying to avoid earnings trading for the time being, but use the earnings for what it is, how they did this quarter, what their guidance is going forward, and how does this quarter relate to the last quarters, because the earnings will start to give you a good feed as far as the fundamentals go for how to long-term invest, and what companies are the ones that you would not mind owning, or probably the ones that might not be in business in the next 12 months.
Perfect. Nope, that's awesome. Well, Dan, I mean, I think we're out of time.
That's it. Every episode goes so quick, but always a pleasure to co-host with you, Tracy, and to all of the listeners out there. As Tracy mentioned, we do have the competition that we're doing for the Pivot Podcast here at Real Life Trading. So make sure you guys either email myself or Tracy, which is pretty simple, either Tracy at reallifetrading.com or Dan at reallifetrading.com. You guys can send us over the trading plans that you guys are working on currently, and also put into that email what your why is for trading, because that's an extremely important, huge factor of trading. It turns the Wild West into a little bit more of a controlled plan with a certain goal at the end of it, which is always good to know where you're going. But thank you guys all for listening. Make sure you guys click the links below this video, and that will take you to any of the previous podcasts as well. You guys have been absolutely incredible, and we'll see you on the next Pivot Podcast.